Hey everyone, and welcome back to the channel. Have you ever wondered why your home loan EMI is so much higher than someone's in the USA? Or why your fixed deposit in India gives you a much better return than it would in America? It all comes down to one thing: interest rates. And today, we're going to answer the big question: why are India's interest rates so much higher than the US's? It's not a sign of a weaker economy. In fact, it's a natural and even necessary part of a country's economic journey. We're going to break down the three main reasons why this happens. The first and biggest reason is inflation. In simple terms, inflation is the rate at which prices for goods and services are rising. Think about the price of tomatoes or milk. If they're getting more expensive, that's inflation. In India, inflation has historically been higher and more volatile than in the USA. The job of a country's central bank, the RBI in India and the Federal Reserve in the USA, is to keep inflation in check. They use interest rates as their primary weapon. When inflation is high, the central bank raises interest rates. This makes borrowing money more expensive, so people and companies spend less. When spending slows down, inflation starts to fall. Because India's inflation has been consistently higher, the RBI has to maintain higher interest rates to keep the economy stable. The USA, as a mature economy, has historically had much lower and more stable inflation, so the Federal Reserve doesn't need to keep rates as high. The second reason is directly linked to the first: economic growth. India is a rapidly growing, developing economy. This means there's a huge demand for money and capital to fund new businesses, build infrastructure, and fuel expansion. Think of it like a new neighborhood with a lot of construction. Everyone needs a loan to build a new house or start a new business. This high demand for money pushes up its price, which is the interest rate. The USA, on the other hand, is a mature, developed economy. Its growth is slower and steadier. The demand for money is not as high, so the price of borrowing remains lower. High interest rates are actually a sign of a dynamic, growing economy. They reflect the high demand for capital and the immense potential for returns. The final factor is all about currency value and foreign investment. Imagine two banks. One offers a 4% interest rate on a fixed deposit, and the other offers 8%. Which bank would you choose? You choose the one with the higher return. The same logic applies to countries. Higher interest rates act like a magnet for foreign capital. They attract international investors who want to earn a better return on their money. This inflow of foreign money helps to strengthen the Indian rupee, INR, against currencies like the US dollar, USD. A strong rupee is important because it makes imports cheaper. This, in turn, helps to control inflation. The USA, with the world's reserve currency, the US dollar, doesn't need to use high interest rates to attract capital in the same way. So, to summarize, India's interest rates are higher than the US's because of three key factors: higher inflation, the RBI keeps rates high to keep rising prices under control. Rapid economic growth. A dynamic economy has a higher demand for capital, which drives up interest rates. Capital flow. Higher rates attract foreign money and help to stabilize the Indian rupee. Ultimately, these higher rates are not a flaw but a reflection of India's unique economic stage. They are the tools the country uses to manage a high-growth economy and navigate its path to becoming a global power.